Wow, the markets just surprised investors and sold off hard. Is the correction that we've been warning about here at Peak Prosperity now finally underway? We asked that question to today's guest expert, Brent Johnson. We also asked him what his dollar milkshake theory predicts for the future of US stocks. It's fascinating. Watch this video to learn for yourself what he says. You know, we've had some pretty amazing guests on this program lately. If you've been enjoying them, please click the like button below, because the more likes these videos get, the more big names we can continue to attract to this program. And now let's get started with this week's market update video featuring Brent Johnson. Hello folks, Adam Taggart, co-founder from Peak Prosperity here, welcoming you back to another week of making sense of these markets. And what a week! Finally, we get something interesting to talk about in terms of the market action. All of the major indices were down and down big today. S&P was down 3.5%, Nasdaq down 5%, the Russell 2000 down 3%, and volatility absolutely exploded with the VIX up 30% today. So we'll get to that and more on today's action later on with the folks from New Harbor Financial in this interview here today. But here at the beginning, we are very lucky to be joined by today's expert guest, Brent Johnson, who we're going to talk to about the US dollar. Brent is CEO of Santiago Capital, which is a financial advisory firm based in San Francisco. He's quite knowledgeable about world currencies, in particular the dollar, and he has a prediction that many of the investors currently betting on the dollar weakening further from here, that those folks may be woefully disappointed this year. Brent, so great to have you join us. Thanks so much for joining us today.
Thanks for having me. I appreciate the opportunity to speak with you and your listeners.
Thanks. All right, well, we're going to dive into the dollar in just a second, but before we do, just let me say a quick hello, as always, to John Lodra and Mike Preston. They're the lead partners at New Harbor Financial, the financial advisory firm officially endorsed by Peak Prosperity. And guys, we'll be chatting about the market action after the segment with Brent. So, hey, John, hey, Mike, thanks for joining us again this week.
Hey, Adam. Hello, Brent. Nice to see you.
Hi. Hey, guys.
Hey, Adam and Brent. Thanks. Nice to see you.
All right, so we're going to talk a lot about the US dollar today, but the world of foreign currencies and exchange rates, often called Forex, is a world that not too many average investors understand all that well. Brent, can you just explain in layman's terms how they work? And when we talk about a strong dollar and what a weak dollar, what exactly that means?
Yeah, long story short, a strong dollar just means that it's appreciating versus the other world currencies, whether it's the euro or the yen or the Brazilian real or the Australian dollar. And in that scenario, our goods would become more expensive for those people in those currencies, and their goods would become cheaper for us. A lot of times people don't want a strong currency, or countries wouldn't want a strong currency, especially if they're exporters, because it makes their exports more expensive. But really, strong dollar, weak dollar, like in the last couple months, we've seen the dollar selling off versus the euro and the yen. And so the common narrative is that the weak dollar. And again, it's just, you have to remember that in the world of fiat currencies, they all trade relative to each other.
All right, and the US dollar has been weakening this year, particularly post the March swoon. I'm putting up a chart here, and you can see how the dollar really has been sort of in steady decline since then. I'm putting up another chart here, care of Sven Henrik, that shows how the dollar is really now sort of at the bottom of its trading wedge here, which is really interesting because I think the dynamic we have right now is, for better or worse, and I hope you can explain to our listeners why, the markets have pretty much decided that the dollar is going to continue weakening going forward into 2020. It seems to be a pretty crowded trade at this point on one side of the boat. You're hard-pressed to find an analyst out there that's predicting a strengthening dollar anytime soon. So obviously, when everybody's over on one side of the boat, the contrarian always wants to make the argument for the other side. And again, looking at that chart that I posted from Sven's, it shows that technically we might be due for a bounce here anyways. But beyond just sort of the technical charts, you have a theory that says that the US dollar is likely going to strengthen much more than most of these analysts expect. It's called the dollar milkshake theory. It's kind of a fun title. Can you explain that, and can you, I guess, give your opinion? Do you think indeed that the consensus of a continually weakening dollar from here is going to be proved wrong this year?
Yeah, so first of all, I'll say I do think that we're due for a bounce. I think we're overdue for a bounce. I agree. I agree with the chart. We're sitting kind of a pretty strong technical 10-year support. To go along with that, we have from an RSI and a DSI standpoint over the last, a couple of weeks ago was the lowest point those had been in 10 years. If you look at the positioning of traders, everybody is short the dollar, everybody is long the euro. So I think a number of factors kick up for the possibility of a dollar jump from here. Now, just because those charts and those graphs and those sentiment readings are saying the dollar's due for a bounce, it doesn't mean there's any guarantee. The current narrative is that the dollar is going lower and that the Fed has everything under control, and narratives are extremely powerful. So if we do break that support, it wouldn't shock me to see the dollar in the, call it the high to mid 80s. Again, I don't think it's going to happen, but it won't surprise me if it does. But if I think if that happens, it happens over the next, 2 to 3 months. But I think over the next 2 to 3 years, the dollar is going to go much, much higher, and much higher than, just about anybody else that I've talked to thinks possible. And I'm happy to go through why I think that is, but that's my position, and I'm sticking to it.
All right. Well, let's go through that. Why do you think the dollar is going to strengthen from here?
Yeah. Well, long story short, I think that we're kind of at the tail end of this debt super cycle. And I don't just mean the United States. Every country is kind of in the same situation. Europe is over indebted. Asia is over indebted. South America has a lot of debts. And the interesting problem is that because the United States has the world reserve currency, these other countries need dollars to operate on the world stage. Now that will change someday, but as of right now, if you're going to operate on the global stage and you're going to trade with the global counterparties, you need US dollars. And so a lot of these countries have taken out US dollar denominated debt over the last 10 to 20 years. Now, that seemed like a good idea back in 2009 when the US was going to print a lot of money, devalue the currency, and that would make it easier to pay off those debts. The interesting thing is that the US printed, a lot of money over the last 12 years, and the dollar strengthened 20%. In 2009, 2010, the dollar index was around 77, 78, and now it's in the low 90s. At one point, it was at 103 earlier this year. So, that didn't quite work out the way a lot of these borrowers anticipated. So now they need, whether they like dollars or not is completely irrelevant. If they want to trade using dollars, that's demand for dollars. So now they have demand for dollars for trade, and they have demand for dollars to service the dollar debt that they've taken out. If they don't pay that dollar debt, they default, and then they've got all kinds of problems. And if they default on the dollar debt, that causes a credit crisis, that causes the dollar supply to contract, and it pushes the dollar even higher. So and we have a number of advantages that kind of help that create automatic demand for the dollar just by the fact of being the global reserve currency, and the fact that we have the dollar payment system. And what I mean by that is when money gets wired around the world for trade, whether it goes from Turkey to Brazil or Australia to Japan, a lot of times it does it through a U.S. corresponding bank, because if you're going to trade in dollars, you need a corresponding bank to wire those dollars, a U.S. bank. And so there's just this automatic demand for dollars out there, and that's getting chipped away at. There's bilateral trade deals. Russia and China will trade some stuff, with one of the local currencies, and you'll see these bilateral trade deals here and there. But the overall arching system still runs on dollars, and I think that puts a floor under the dollar.
All right. So I've got some questions around that, but before I get to them, just a question for the average listener here, which is, why should they care? Why should the average American investor care whether the dollar is strong or weak?
Well, it's a good question. When Richard Nixon devalued the dollar versus gold, he basically said you shouldn't care. It doesn't matter. If you go back and listen to his speech, he said that your price of goods will still be the same, but it's a little bit of a misnomer.
Yeah, he also said it was going to be temporary too.
Exactly. And that was 50 years ago now, 50 years ago now.
49. And I only know because it was 2 weeks after I was born. Yeah.
Right. So I think it does. Here's the interesting thing. I don't want to say it doesn't matter, because it absolutely matters, but it matters more for people in other countries than it does for people in the United States. Part of the reason that most people in the United States don't understand currencies relative to each other, because we've grown up and we've lived in a country in which we are the global reserve currency. As a result, the value of the dollar doesn't fluctuate that much as typically other currencies do. If you go to Europe and you talk to anybody in Europe, they're much more familiar with currency exchange rates. Talk to somebody in South America, they know what the dollar exchange rate is. You know, you talk to the average person in San Francisco or New York or Texas or, you know, Chattanooga, Tennessee, and you ask them what the exchange rate to the Brazilian real is, they're not going to know. But if you go to Rio and you ask them what the exchange rate to the US dollar is, everybody's going to know what it is. And it's because, you know, everybody needs dollars to trade. And in those other countries, they don't only save in gold, but they save in dollars, because they know in a crisis, dollars is what they're going to need. So I don't know if that answers your question or not, but I think that's it's an important thing to remember.
Yeah, well, so, you know, I think this is correlation, not necessarily causation, but a weak dollar generally tends to help the stock market, tends to help equities. And again, probably correlation, but we've certainly seen with the massive rally that we've had off the March lows, that's corresponded with a pretty tremendous, at least relatively speaking, tremendous weakening of the US dollar. Should the dollar suddenly go through a strengthening phase, would we expect equities to roll over as a result of that, or might that just be something that could concurrently happen?
I think, and again, I don't know in all this. A lot of times people say, well, Brent, how do you know this? And the truth is, I don't know. I have a theory, and I think I know how it's going to play out, but we're all just speculating at the end of the day. But most likely what has happened is the next time the dollar gets stronger, it will probably be as a result of some volatility or a, you know, part of the, some sell-off in the market. I think the next time the dollar gets stronger, equities likely sell off, similar to March. When I think ultimately, whether it's 6 months from now or a year from now, I think we're going to get into a sovereign debt crisis. And what I mean by that is around the world, not just the United States, but around the world, people are going to wake up to the fact that governments are never going to pay them back on all this debt that they've borrowed. And as they start to sell sovereign debt, whether it's Chilean sovereign debt or Brazilian sovereign debt or Turkish sovereign debt or Australian sovereign debt or Chinese sovereign debt, I think one of the places they're going to look to go is to the United States, and they will look to go to companies like Coca-Cola or, you know, Lockheed Martin or, you know, Hewlett-Packard, some of these bigger blue chip companies that, you know, will act as a store of value for that person in that other country. Remember, if you're in Brazil and their currency is falling, even if the US dollar is just sitting there and the Coca-Cola is just sitting there, if the Brazilian real falls 10%, they just made 10% just by holding Coca-Cola, and then they get a 4% dividend, and all of a sudden they got a 14% return. In that environment, I think people are going to want dollars. To buy Coca-Cola, you have to buy $1 first. You can't buy Coca-Cola stock with a Brazilian real. And so or an Australian dollar or a, you know, Colombian peso. And I think we're going to, as we get further into this debt crisis, the sovereign debt crisis, the dollar will be sought out as a safe haven, and then I think it will find its way into US assets. And I think that's when we will get into a period where the dollar and equities rise together. And I think gold probably rises in that environment as well.
All right, great. So you're getting to the territory I was just about to ask you about. All right, so as you said earlier, there's sort of always kind of a bid under the US dollar to a certain extent by all these sovereign nations that have to borrow, and they have to service those debts in dollars. But one of the things we've largely said, that we've said for a long time here at Peak Prosperity, is that collapse happens from the outside in, which means that it's the weaker players on the board who falter first, right? And if you think back to 2008, you know, Greece was that for Europe, right? It was pretty much the weakest player. They were the first one to fall, and they were the ones that had the hardest time. So, you know, you're saying in these developing countries around the world, as we, you know, really begin to get into a global sovereign debt crisis, where investors kind of wake up to the fact that the risk is higher than they want it to be in sovereign debt, and they start selling that sovereign debt, they get the proceeds from the sale, they need to park it somewhere. You're saying, you know, cleanest dirty shirt, you know, the US is going to look the best relative to other economies. and they're going to put their money to work here, maybe some in the safety of treasuries, but to your point, put them in blue chip stocks. And they get a really nice return on that if their currency continues to weaken versus the dollar. And you mentioned dividends as well. So yeah, we could have some sort of situation here where it's almost kind of the best of every world for American investors, which is your dollar strengthening so that your purchasing power, should you ever go abroad, is good. And your equity markets rising because all this capital is flooding from the world coming into the U.S. You also mentioned gold. So for our crowd, which are people who are generally, a little bit worried about, I mean, honestly, they own gold because they're worried about the dollar. So we kind of get into this interesting set of cross currents where the dollar could be going up. But gold could be going up relative to the dollar too, right? I mean, it could still be going up while yet depreciating against another hard currency like gold, right?
That's right. And I think a lot of times when people have a hard time with this thesis is that one of the core reasons you own gold, as you just said, is to protect against yourself against the debasement of your own currency. And the point I want to make is that the dollar can be debased and still rise versus every other fiat currency. Because it's, the idea that the US is a horribly run currency and all these other fiat currencies are fantastically run fiat currencies is a complete myth, right? Those governments are just as out of control as ours. It's just that we have several advantages that they don't. And as a result, I think they're going to have to print their currency, quote unquote, even more than we have to print ours. So on a relative basis, the dollar will rise versus them, but the gold may be rising versus all fiat currencies. And that's when I say the dollars and gold rise together, I mean they rise together versus all other fiat currencies.
Right, they rise nominally versus other fiat currencies, but relative to one another, gold may be rising relative to the dollar.
Right, and I've always said that the gold is going to win in the end. Gold is going to go to at least $5,000, probably much higher than that. But the idea that a fiat currency is going to outperform gold over the long term, it's provably false, right? Everybody needs to own gold. It's probably the most important asset in a portfolio. But the other point I always like to make is you don't have to choose between dollars and gold. I would never tell anybody to put 100% of their portfolio in gold. So if you don't have 100% of your portfolio in gold, that leaves a lot of more room to have dollars, right? Let's say you had 50% of your portfolio in gold, which would be a lot, but I know some people out there do. Well, that's still 50% now that you can have denominated in dollars. So you don't, just because you think the dollar is going to fall versus gold doesn't mean you have to put all your money in gold. There's a lot of ways to make money in a diversified way and still hold dollars.
Got it. All right, a couple rapid fire questions for you here. So you mentioned, sovereign debt crisis global sovereign debt prices could be good for U.S. equities in terms of driving capital into them. You're not necessarily saying run out and buy U.S. stocks tomorrow, because obviously one big question in that decision is, well, how fairly valued are U.S. equities right now? I'm going to be talking with John and Mike soon, picking up a thread that we've been following for weeks now in terms of U.S. equities being at some of their most overvalued levels in history, depending upon the data that you look at. Do you have an opinion right now about the fairness of the valuations in the U.S. equity market? Would you be a sort of a general buy U.S. stocks today guy, or would you put a caveat on it?
So I own stocks for clients. I think they're overvalued right now. I think that we're going to have another dip, so to speak. I don't know if we'll go back as low as we did in March. That was pretty extreme. But I do think we'll have another sell-off, likely between now and the end of the year. But I think between now and the end of the first quarter, if not between now and the end of the year. And then I think after that, though, I think we're going to start getting into this crisis. So if we do get that big pullback again, I think you do have to have some of your portfolio allocated to U.S. equities. And while I'm not going to sit here and be the guy that says valuations don't matter, because that would just come back to haunt me. But I do think that we're going to see more of the craziness that we've seen the last 4 months. I think we're going to see more of that over the next couple of years. So I do think we need to have a kind of a washout to kind of reset sentiment. But after that, I think governments around the world are just going to spend, and central banks around the world are going to spend. And I think most of that money is going to end up in the United States. And I think that will push U.S. stock prices higher in the years ahead.
Okay, last couple of questions for you, because I've already taken up a ton of your time. I know you're giving us time out of your busy day away from clients. So again, thank you, Brent. And this is super interesting. So thank you. So you just mentioned, central banks and expecting, the craziness that we've been seeing that it's not over, that you expect to see more of that in the coming years. So obviously central banks have been on a spending spree for the past decade, right, with all the different rounds of QE. That got turned up to 11 on the dial post-coronavirus arriving on the scene. What do you think about the actions of the world's central banks? What impact do you see that having on currencies? And is that the main reason why you said you expect this craziness to continue for some time going forward?
Yeah, I mean, I really think we're getting into this period where central banks are almost, I'm not going to say they're done. Central banks are incredibly powerful, and they've got more tools than we could ever imagine. But I think we are kind of getting towards the end of what central banks can do. And I think they're going to start handing off to the fiscal side. And I think governments are going to just, spend. And then, we probably don't have time to get all into that, but then we get into this whole MMT where rather than borrowing money and loaning it into existence, they just spend it into existence. And whether that's via some kind of a digital coin, or the government just, says we're going to, ship, stimulus checks to everybody for 5, 10 trillion, 15 trillion.
Or nobody pays taxes or whatever.
Right. And again, I don't think it's just the US that's going to do it. I think the whole world is going to do it. I just happen to think that, I think in today's day and age with global capital, and there will be capital controls put up around the world to try to prevent this. But where capital flows freely, I think it's going to flow to the United States. And it's as we suck up that capital, that's where the whole dollar milkshake comes from, is I think we're going to suck up that global capital and it's going to find its way into US assets. And we're going to have this, melt up, for lack of a better word. It's going to end horribly. I need to say that. I'm not a Pollyanna who thinks this is a fantastic thing for the United States. It may push asset prices higher, but it's not necessarily a good thing long term.
All right. And is owning gold a big part of why you say this is going to end horribly? So have some gold. Is the gold a defense against that?
Yeah. I mean, the great thing about gold is great in either a massively deflationary or a massively inflationary scenario. And we're going to end in one of those two things. We're either going to have massive deflation or we're going to have massive inflation. And under either scenario, gold will be your bedrock. And that's why I think everybody should have it. I can't remember who it was, it might have been Kyle Bass or someone 10, 15 years ago said something, or maybe it was Jim Grant said something like, having gold is just like having a put option against the political idiocy in the world. And that's really what it is. The people who are running the world they may be well-intentioned, but they're very misinformed and misguided, and they're going to fail. And when they fail, gold will be a very good friend of yours.
Great. Well, I think that's another asset we're having a melt up in right now, political idiocy. So gold is probably a good thing for that. All right. I want to let the guys from New Harbor ask a question because I believe they've got one around interest rates and what you were saying. John, do you want to field that?
When we talk about global currencies and global capital flows, it's almost impossible to not think about interest rates and inflation and the interactions between all these factors. You have any kind of thoughts about, kind of in the scenario of a strengthening dollar you've talked about there, really what that means in terms of interest rates and inflation, and there's a chicken and egg component to those.
Yeah.
But,
so I think in general, I think central banks have made it abundantly clear that they are not going to raise rates. But it's important to remember that rates can rise anyway. At the end of the day, if markets, which is kind of the collective wisdom of all the individual investors put together, if they decide that they no longer believe what the central bank is selling them, markets can do whatever they want. And I think what was likely to happen is that overseas, interest rates will start to rise, not because things are getting better, not necessarily because we're getting some growth, but because things are getting worse and there's a counterparty concern, right? If you're going to own a junk bond, you want to get paid more for it. You could argue that a number of these European countries and Asian, and even you could even argue Japan's the same, as it's not a AAA rated credit, but it's yielding negative or next to nothing. I think as we get into this crisis and these bonds start to get sold, that interest rates will rise on those bonds. And I think the U.S. at that point, then I think the U.S. interest rates will fall back below. Like right now, U.S. has kind of the highest of the major currencies interest rates. They're really low, but they're still higher than the major competitors. I think that's going to flip, and I think, you know, it'll be back to where the U.S. is the lowest yielding sovereign. But if interest rates really start to rise because everybody's selling those foreign bonds, so they really start to rise overseas, I think then that also puts pressure on U.S. yields to rise. And in kind of a converse way, if you need dollars, but now you can also get paid a little bit more to own them, it's actually beneficial for the dollar. Again, you got to understand why interest rates are rising. If interest rates are rising because, you know, there's some inflationary pressures and there's some growth pressures, then that's a positive thing. But if interest rates are rising because people don't trust the currency and don't trust the bond, that's a bad thing. So again, I don't think this is all going to play out really smoothly and it's going to be easy. I think it's going to be really volatile. I think it's going to be really scary. I just kind of think that this is kind of how it's all going to play out over the next 2 or 3 years.
Yeah, I guess I actually have one kind of bigger picture question. You know, if you look at the dollar index over the last several years, you know, obviously in recent months it's been very weak relative to other currencies. But you know, going back to 2015 or so, you know, we've kind of got a channel here, you know, kind of sideways, you know, band, if you will. You know, back in early 18, I guess it traded down just below 80. You know, we're not quite there. So I guess in the context, you know, the idea of, you know, the U.S. being the cleanest dirty shirt of currencies, that's not a new idea. In fact, the last decade has been, you know, central banks one-upping themselves in terms of desperate measures. You know, what about the future is so novel that we can't look to the recent past and see that really the dollar's kind of just been somewhat range bound, even despite the recent week.
Yeah. Well, I think ultimately, and I think I'm gonna use an analogy that I think a lot of your listeners will understand, because, you know, I think a lot of your listeners are gold owners, and I think a lot of your listeners have understood the argument that gold, one of the reasons that gold will go higher is that there's all these paper claims on the COMEX, but there's only a certain amount of actual gold. And the minute everybody stands for delivery, gold's going to go through the roof. So the same thing exists in the fiat currency world. The monetary base, which is the physical currency that actually exists, and the reserves at the Fed, those are the only dollars that actually exist. But the monetary supply, in other words, all the claims, are much bigger than the monetary base. And if everybody that, you know, has a claim on dollars stands for delivery and tries to get those physical dollars, that's a run on the bank. And that's the same thing as a run on the COMEX. And that's exactly what we saw in March. In March, we saw a run on the dollar. Everybody wanted physical dollars. They sold everything they could to get dollars. Now, they didn't sell what they wanted to sell. They sold what they had to sell. And that's why you saw gold go from 1,600 to 1,450 over a couple of days. I don't think people wanted to sell gold. I think they had to sell gold. I don't think people wanted to buy dollars. I think they had to buy dollars. And so I think, you know, to your point, as long as the system is fine and going, maybe the dollar just range bounds, you know, maybe it goes up and then it comes back down. I just think the global debts have gotten to a point that this isn't going to last another 20 or 30 years. I think it might last another 2 or 3 or 4, but I don't think we're going to be having the same discussion in 2030 or 2045. I think we're kind of getting towards the end here. And I think as these debts around the world collapse and the claims on those dollars start to pile up, I think the dollar is going to go higher.
All right. Well, wrapping it up here, Brent, because like I said, we've already taken up more of your time than I promised I would. Thanks for being so generous with it. Just 2 last questions for you. Very short answers. But this is not personal financial advice. But to the folks listening, what would be your general advice to today's investor who is concerned about, you know, the risks that we've been talking about here?
My first advice would be own some physical gold. Second advice would be to have some cash, like real cash, either in a savings account or in physical cash that, you know, can get you through, I don't know, 6 months or a year, because you might need it. I don't know. But I think the two most important things you can own right now are cash and gold. And then after that, I think if we do get another pullback in equities, I think even though maybe it kind of goes against your better instincts, I think you should have some exposure to large cap U.S. equities.
All right, thank you. That's a perfect springboard into the discussion I'm just about to have with John and Mike here. So Brent, as we let you go, if folks are interested in learning more about your work and following what you do, where should they go?
So I have my contact listed on my homepage, and listen, my website is literally just a landing page with my contact information, but it's santiagocapital.com. You can email me, brent@santiagocapital.com. I'm pretty active on Twitter, so you can find me at Santiago AU Fund, or you can just type in Santiago Capital and find me that way. I'm always happy to respond to people. I'm always happy to kind of interact. I get a lot of messages, so if I don't get back to you right away, feel free to send it again. And I apologize if I don't get to you, but I always appreciate interaction with individuals, and I appreciate you having me on today to be able to speak with you and your clients.
A total pleasure, Brent. Really appreciate you coming on. I hope we have you on again at some point soon. And if the dollar strengthens anytime soon, we're definitely going to get you back on here.
Okay, great. Thanks, guys. Nice to meet you.
Thanks a lot.
See you, Brent.
All right, John and Mike, that provides a great platform to talk about what's going on since last week. And frankly, the real news is in what happened today. Markets are down. I'm going to put up the indices here again just for a second. But markets down big today. First down day in for freaking ever. I think there were 2 down days, maybe 3 down days in the entire month of August. But as we've been warning people about, as Sven Henrik said when he came on the program 2 weeks ago, he said, look, when this correction starts, and we don't know if this yet is the start of a larger correction or not, but he said it's going to come fast, it's going to come out of the blue, and there's not necessarily going to be like a trigger for it, a news trigger for it. He said when markets get as distorted as they become, you kind of have to just sift through the dust and try to assign cause to it as a Monday morning quarterback, because oftentimes what happens is it's not a particular trigger, it's just things got so extended that there was some mathematical limit that nobody knew what it was going to be, but you hit that limit and then all of a sudden the market reverses. So big reversal today. I want to put up 1 or 2 charts here, and then I want to get some questions to you guys. The first chart I want to put up here is this one of the South Sea bubble, because I think it's really indicative of the market that we've been living with. We've been telling investors week after week after week, don't be fooled by this mania, don't be sucked in. The job of a bear market rally is to make you, believe the hype and to jump back into the market. So you look at this chart here. This is the South Sea stock bubble, one of the largest bubbles in history. Isaac Newton, one of the smartest men in all of human history, he invested early on, made a ton of money, and exited and felt great about it. But then as what happens in asset bubbles is the price kept going higher. And after a while, Newton kept hearing at parties how much more money his friends who had stayed in the stock were making, and began feeling kind of like an idiot, and finally decided he couldn't take anymore, jumps back into the market. Of course, at that point, he's one of the last suckers jumping in. The South Sea bubble corrects, and he exits broke. This chart doesn't have the amount that he lost, but I think I've heard it was something like 20,000 pounds, which back then was a complete fortune. And it just goes to show that even some of the biggest geniuses in human history can fall prey to the type of mania that we've been seeing in the markets of late. So, our big role has been to try to keep people grounded and to hopefully keep them from getting suckered in to be one of those last people that jumps in before the bubble breaks. So, guys, with that said, let me just hand the football to you first here. What is your reaction to what you've seen today?
Adam, I think I'll take a shot at that. I mean, nobody knows, like Brent said, what the future holds for sure. And today is only one day. We want to be clear about that. It's only one day, but it is markedly different than most of the days before that over the last couple months. Like you said, we had hardly a down day at all. I think there was 2 in August, and they were hardly down. And this market has been a relentless train higher every day, and every small dip has been bought immediately. It has been one of the most one-sided rallies we've seen in our careers, and there's been many. I mean, it's been similar to.
Would you not say this is the most one-sided rally you've seen? You've seen worse?
I would say it's the one, but the last few years there's been several that have been up there in rank. I mean, post overnight repo madness in the fall of last year, it was pretty relentless. January and up to February 19th of this year was pretty relentless. And just like February 19th, there was not much of a catalyst here for today's break. Back then you might have said it was the coronavirus, but the coronavirus was around for a month before February 19th, before the market decided to roll over. But we have been seeing such relentless one-sided action, plus some technical indicators that are just insane. I mean, just taking a look at I'm taking a look at a few indicators here. I know you can't see them, but just looking at the advance decline ratio, there's been lower and lower and lower participation. That is less advancers than decliners in the New York Stock Exchange overall. Off the March low, the breadth was poor, and it got worse through June, worse through July, and even worse here at the end of August and September. I mean, it's been a lot of commentators and people that have watched this market are completely dumbfounded, but it hasn't mattered because everyone's like, well, the Fed's just going to keep printing. The market's never going to go down. Such is the euphoric moment that you just sit back and can't even believe it anymore. That's kind of what we've been living through. And at the same time, we see valuation measures that are off the charts. Market cap divided by GDP of 180%. These are numbers that have really never been seen before. Long term, a market cap to GDP of over 100% defines a bubble, the old Buffett indicator. Couple other things. Taking a look at an S&P chart, this week it had basically a what you might call a throwover. It burst outside of a channel going back to 2018. We're about 20% higher than the January 2018 levels. We burst through that, through an uptrend line with euphoria and with bad participation and bad volume. And, all the story stocks are out there, Apple, Tesla, et cetera. The other day, Zoom went up 40 or 50%. So, there's just all kinds of examples that this is a pretty historic moment. And then, so today, there's a reversal, and it's only one day. But I guess I'd point out, we don't know what tomorrow is going to bring, but if we close down tomorrow significantly, certainly below 34.15 or so on the S&P, we'll have a weekly bearish engulfing week on the S&P, and it wouldn't take much for the Nasdaq to have a bearish engulfing week, all while breaking out of a channel, then closing back within a channel. So we'll have to see what happens, but it certainly has all the hallmarks of a buying climax at a time where valuations have never been worse. Euphoria has never been more extreme. Just sentiment levels are off the charts. I mean, there's, the people have just gotten religious about this market. And the backdrop of all of this, of course, is coronavirus is still here. Demand has still been destroyed to some extent. A lot of small businesses are going under. Wealth disparity is getting worse, et cetera, et cetera. So, our story is the same, as boring as it sounds. We're still very cautious, very heavy in short-term cash T-bills, a little over 2/3, with some exposure to a few different things, including gold mining stocks, some emerging markets, and some short exposure to the U.S. market to basically put us at a net zero equity exposure. We expect there to be better opportunities ahead. We expect there to be a tailwind still in gold mining stocks. And hopefully we're going into a period where there's going to be more opportunities. So in a nutshell, that's what we see.
Okay, good. And I want to talk about that in just a second, because I think Brent made some interesting points about U.S. stocks, but probably U.S. stocks post some sort of correction here. I'm going to put up the chart I think you were referencing earlier, Mike. This one is, again, care of our buddy Sven Henrik, but you'll see here, this is the multi-year channel that Mike was talking about that the S&P has been in. And as you can see here, it's tagged the top of this channel 3 times. And you can see in the yellow rectangle here at the right where it's just tagged it really yesterday. And Mike was mentioning it was sort of threatening to punch through this multi-year trend line. Well, instead it reversed, and we had today's substantial reversal. And if you look at this chart, you'll see that when it has hit the top and corrected, it usually tends to come down, if not all the way, pretty close to the bottom line of the trend channel. So, if you're looking here at the S&P, that would be going from about 3550 to where it was yesterday, down to like 2100. Who knows if that's going to happen? But I mean, that is not something the market is expecting right now, and that would be total carnage. Now, can we make an argument that it should do that based upon the level of overvaluation? Absolutely. And I think, folks, that's the kind of thing that you really need to be keeping your eye on here is, as Brent said earlier, it's really all about, when you're talking about currencies, it's all about relative valuations. When you're talking about the stock market, it's all about relative valuation to historic metrics. And yeah, Tesla might be at an all-time high, though not anymore. But relative to perhaps what fair value of that company is, it could be way, way, way above that. And speaking of Tesla, let's actually look at Tesla shares here. So here's a picture of Tesla shares over the past week, and you can see here that they hit a high of $500 a share yesterday. Now they're down at 407 as of the close today, and actually last time I looked in the aftermarket, it was pretty much down to 400. So that's a 100-point drop from peak to current trough. That's 20%. That's a bear market. It took Tesla less than 48 hours to enter a bear market, something that nobody was expecting yesterday. So just when we keep telling you about the fact that tops are processes, they can take a long time, but corrections are events. They can happen more quickly than you can have time to react. And I think what's happened in Tesla over the past 48 hours is a great example of that. And I'm putting up another chart of Tesla. This is the 1-year chart of Tesla. You'll see the stock went from about, and these are post-split prices, went from about $50 a year ago to $500 yesterday. That was a 10 times increase. And folks, nothing in this company grew anywhere close to that time, even grew close to 2x, not revenues, not earnings, not anything. So not car deliveries. And you can see here, even with this recent 20% correction over the past 2 days, the stock is still crazily up over the past year. So, making the argument, is there further, perhaps an awful lot further for a stock like this to fall? Absolutely. All right. And then the last point I want to make with charts here is this next chart from Sven Henrik again. I'm just a huge fan of his technicals, which is why we had him on the other week. You'll see here, Sven refers this to the market of the gaps. Over the past, whatever it's been, 5 months or so, climbing up from the March lows, there had been many gaps that the market had opened as it dropped quickly that it had closed. And there's a saying in the stock market that, gaps get closed. We just closed one of the last outstanding gaps that was existing in the chart series just a couple days ago with the Dow closing its very last gap. So basically what I'm saying is on the rise back up from those March lows, the market has made tons and tons of gaps up. So while we have no more gaps above us to fill, we have tons and tons of gaps below us to fill. This chart is just for the month of August, and you can see here there's 4 big open gaps here for the S&P, and that's just for the month of August. So there is a big danger. Those gaps sort of act like a gravitational pull, trying to pull the markets down to fill them. And if we blow through these gaps below us here in August, there's a whole bunch more gaps from July, June, May, and April to fill too. So again, not saying they're necessarily going to get filled, but saying that history shows that A, gaps do tend to get filled, and B, there's no guarantee they're not going to get filled. So you just got to be aware of that downside risk lingering there. So guys, as you're looking towards, sort of what you expect to have happen from here, what type of, what are you going to be looking at most to see whether or not this today's correction has legs? Obviously we've seen, kind of every down day in the past 6 months or so kind of gets met by, a massive amount of buying, oftentimes a lot of rescue packages from either the Fed and or Congress. So there is a chance that this just becomes a blip in the continued upward trajectory. But what are you going to be watching closely to determine whether that's going to be the case or not?
Adam, just a quick point before answering that. We can look at the technical channels, like some of the great work that you put up there by Sven, and certainly from a technical standpoint, retreating to that lower channel is certainly something that is possible, maybe almost expected from a technical standpoint. But make no mistake about that, as if that's kind of the technical downside target near term, that is not synonymous with reaching valuations that are anywhere near what would be considered fair or durable from a long-term investment standpoint. We're talking much lower than that. 1,1300 and the S&P is probably what we're talking about, not 2,100. So just put that in perspective.
Yeah, and John, just to restate what you're saying it could actually drop to the lower end of that channel which was around 2,100 on the S&P, and you would say, hey, we think that might still be 50% overvalued.
Oh yeah, it doesn't mean it goes there in a straight line. Certainly there's probably some tactical trading opportunities around there, but make no mistake about it, it's not the all clear. No way. No, again, with perspective of where valuations have been historically, not even close to the all clear. But to answer your question, kind of generically about the kinds of things we'd be looking for, it's the simple answer is kind of the opposite of what we've seen lately. Better valuations, much better breadth. This rally over the last, several months has been increasingly narrow and narrow and narrow. I mean, Mike, I think already talked about, kind of the number of gainers versus losers, steadily, not showing participation in the highs, a handful of stocks. We used to be able to say that, 2000, even though the tech bubble was more egregious, in the super high cap, large caps. We can't really say that anymore. John Hussman does great work. He just put out a monthly commentary and breaks the market up by decile. And every decile is we're even on the top decile, we're almost as overvalued as we were in the tech bubble. But more concerningly, all the other deciles are vastly more overvalued than they were back then. So, we want to see, in a nutshell, a lot of the opposite of what we've seen here. Better breadth, better, internal consistency, not just a handful of stocks, kind of carrying the market higher. In fact, we want to see the opposite. We want to see a handful of stocks carrying the market lower, showing that the market internally is starting to find some footing. And again, in a blanket way, it's the opposite of what we've seen, without getting too specific.
All right, so let's just assume for a moment that this does have legs and that this does become a material correction. What does that mean? I don't know, but let's just, for argument's sake, let's say we end up over the next month or two going back and touching that trend line, right? 21,100, that type of territory. I want to go back to something that Brent had said, which was, long term, there may be some secular forces that are really supportive of U.S. equities, at least sort of big blue chip U.S. equities. So I don't know if 2,100 is the right level. Maybe I shouldn't have picked that number out. But let's say prices get back to an area where you guys start feeling like the valuations are beginning to come in line with the underlying values of the companies themselves. What I took away from Brent was putting words in his mouth, but I think this is what he was saying. Is, hey, you should have a portfolio that's got some cash for emergencies, has gold both for safety, but also for appreciation potential in a world where everything devalues relative to gold. And then you should be, deploying your assets when valuations make sense into kind of, select industries in the U.S. and some of the bigger blue chip players. What's your guys' general reaction to that? Because you guys are money managers. We send lots of people your way who are looking for a financial advisor who is aware of the risks going on here. They want them to safeguard their wealth, but they also want them to prudently grow it over time. Given how I just sort of described what sounds like Brent's approach is, what are your thoughts on that? And does that jive with sort of how you're looking at your strategy?
The devil's in the details in terms of position size. So absolutely, on a pullback like that, we actually had one back in March. We added about 15% incremental equity exposure to client accounts, not because we felt the market had reached generational lows or screaming values, but because there was certainly some overdone, donedness on the downside, if I could invent a word. And we felt there was a very high probability of a sharp rally. Now, there's a way to do that with belt and suspenders. That's where hedging tools can come in play. So you need not be kind of, letting down your defenses, but still participating in some potential. And we kind of like to use the analogy of a football game. If we're going to be on offense or defense, there's many different kinds of shades of offense and defense. A retreat down to 2,100. Yeah, run some offensive plays, but do them very cautiously. Do them with some hedges in place. we're down at 1,500, you run some more aggressive plays. Maybe you don't need such robust hedges in place. And man, if we get to 1,200 or 1,300, that's the kind of generational or at least multi-year, even maybe multi-decade kind of buying situation where you can, I think, reliably or confidently invest in a more traditional portfolio and expect that over the next decade it's actually going to do well for you. Versus right now, if you look at where valuations are, there's no reason to expect the market's going to do anything for you for the next decade and probably lose a little bit. That's what the math suggests.
All right, so Mike, I'm going to come to you to let you have the last word. Real quickly before I do, I'm just going to put up two quick visuals here. The first is the sort of bubble psychology chart that we've mentioned in a number of past weeks. But I just want to remind folks, what we've sort of been warning folks is that our general consensus is that even though it's been an incredibly strong one, that we have been in a bear market rally since the March lows. And looking at this chart here, the bear market rally is that second spike in this chart here over on the right. And it's titled Return to Normal because its goal is to try to make you feel like the initial correction was an aberration and that things have returned to normal and are only going to get better from here. And that's exactly the period where Newton got suckered in to the South Sea bubble. And I think that's when, the last and potentially greatest fools in any mania, arrive at the table and find out that they're the patsy. So, a big part of these videos has been trying to keep people grounded so that you hopefully don't jump in and become that patsy there. But the reason why I want to bring up this next chart is to say, folks, we are not going to return to normal. We just can't. And the reason for that is the damage that the coronavirus and the associated economic slowdown and decrease in economic activity has done to the global economy. And this chart here is showing job losses in previous U.S. recessions. And you'll see it's just night and day. There's nothing that compares to what's going on right now in terms of severity, in terms of swiftness, in terms of scale. We have lost an unbelievable amount of jobs in an unbelievably fast time frame. And really, this time too, there is a very good probability that a lot of those jobs may not come back for years, if ever. And so it's very different than what we've ever had before. And so in no way, shape, or form, folks, is this normal. And so expecting a return to normal, I think is really setting yourself up for a very dangerous disappointment here. So with that said, Mike, we're coming to the end of the time for this week. We've had a little bit of answer from the markets to the questions that we get every week from some small but vocal population of the comment section on YouTube that says, hey guys, every week you warn us about the markets, but the markets keep going up and up. When are you guys going to admit that it's different this time and that it's only going to be an ever increasing stock market? I think today was a really good reaffirmation of why we keep sounding the cautionary tale. But what kind of closing remarks do you have for investors that are sort of, trying to determine what to do, especially if they're not already working with a professional financial advisor like you guys, who's been keeping them aware of the risks that are in play?
Number one thing, reduce exposure to risk. I mean, we're not at the exact high after today, but we're pretty darn close to the high. This is a fantastic opportunity to reallocate your portfolio. We're above the February 19th high still, not far from it. I mean, we're maybe about 50 S&P points from that February 19th high. It's still a great opportunity to reallocate. Get yourself down to 30% or below equities. It'll give you much more ability to be flexible and to push more chips on the table at lower levels. Like John said, though we can't predict this, math says that normal valuations are somewhere more around 12 or 1400. We have to be at that level just to get 10% expected returns in the market over the next decade. At present prices, we're looking at negative, 2%, 3% expected returns, even in a balanced portfolio. That chart that you showed that shows the return to normal. The market's job is to fool the most number of people most of the time. This bounce off the March low has been relentless and has been straight up. And it's, we took out the February high. A lot of people capitulated in, shorts capitulated out. And everyone is convinced or was convinced that everything's back to normal and the Fed has got this forevermore. We still think that's not the case, and it's almost setting up a perfect storm here of people that are, maybe feeling bad for not buying the dip in March. And now they're going to go ahead and buy the next dip because hey, they're not going to miss it again, right? And at these valuations, at this deep in the kind of the era of financialization, if you will, which we think might be ending, by the way, 50 years along, it really, you run the risk of buying the dip all the way down because you've been taught 500 times that it works. And the one time it doesn't work, it easily could wipe you out, even if you're sitting on lots of gains over the years, because that's what Isaac Newton did. He bought some more, he bought some more, he bought some more until he couldn't buy anymore. And we certainly wouldn't want to see that happen. Again, there's this throw over in the markets. The Nasdaq, the S&P hit new highs. Other ones didn't, like the transports, the Dow, the New York Composite. A very thin market. All of the technical indicators scream caution. And at the same time, the chorus is that it doesn't matter, that it's different this time. Well, we don't think it is. Take the advantage, reduce risk, get down to 30% or less. The lower, the better. We'd be happy to talk to anyone if they would like some advice. That's all I have got. Thanks.
All right, great. No, I think it's very well said and a great end cap to today's great discussion. So if you're watching this and you're not currently working with a financial advisor who understands the risks that are in play, definitely feel free to give the guys at New Harbor a call. We've sent them literally hundreds of people over the years. They've done a wonderful job in safeguarding people's wealth. Quick example of that, guys, when the markets dropped in February, I know there was one point where we had you guys on and the market, I think, was down like 33%. You guys were pretty much flat. I think you were up even 1% or so. And that's kind of the difference of what the type of financial advisor we're talking about can do for you. They're not necessarily the guys to say, we've got a secret magic formula and you work with us and you're going to make 10 times what people in the street are making, because nobody has that type of magic. But what they do say is we will be very good safeguards of your wealth. And that's why we keep hammering home caution and minimizing downside risk every week, given the incredible distorted states of today's markets. So, again, my advice is work with a great financial advisor that can, create such a safeguarding plan for you. If you've already got one, fantastic. If not, though, consider talking to these guys. You can do it for free. No expectation or commitment of working with them involved. Guys, I will put up the Greylock Peak URL here on the video every time you guys are talking, so that people know how to get a hold of you. And if folks are interested in talking to them, stay on to the end of the video here, because we give you kind of all the details on how to do that easily. And with that said, John and Mike, another great week. Finally, something interesting. Really hoping it's not just a day of interest and then back to normal, but we will find out. And we'll be back again next week to see where the markets have taken us. But with that, thanks for coming on again, guys, and we'll see you next week.
Thanks, Adam. We'll see what happens, and we'll see you next week.
Yeah, thanks, Adam, and happy Labor Day weekend to all the folks in the U.S. Listening in with us.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.